If you're a real estate investor and you just heard about the DSCR loan, but you're not fully sure whether you should go that route or the traditional conventional investment route, this video will clear that up for you. Welcome to the channel. If you're looking to grow your real estate portfolio, then you're in the right place. In this video, we'll be covering the differences between the traditional investment mortgages and the DSCR loan. Let's get into it. Let's start off why majority of people end up going the DSCR route. The biggest reason is there is no income verification needed. The traditional route requires a certain debt to income ratio. They will need to calculate how much income you're making by requesting income documentation, such as your pay stubs, W-2s, or tax return. They'll also have to verify your employment history. On the DSCR side, there's no income documentations required, no employment history required. They're going based off of the property itself. DSCR loans look at the rental income on the property. As long as that rental income is covering the mortgage amount, majority of lenders are okay with that. So DSCR, if you don't know, stands for debt service coverage ratio. What that basically means is that the debt is being covered by the rent. Some lenders are willing to go to a 0.75 ratio, which means that you're actually taking a loss and they still will be able to qualify you. Of course, rates are a little higher. This is an example of how they calculate that ratio. You divide the rent by the mortgage amount. So if your rent is $1,000 and your mortgage is $1,000, you divide the rent by the mortgage, you get 1. Now, no income verification and no employment history is huge for self-employed borrowers or for anyone that cannot show the debt to income ratio needed for the traditional investment route. Another reason is that the conventional investment loan, I believe, caps you at around 10 finance properties at a time versus the DSCR loan, which allows you to have even more financed at a time. Some lenders are willing to do 20, some lenders are willing to do over 50, and some lenders, I don't believe they even have a cap. Now let's go over the interest rates. I've noticed that with conventional and DSCR loans, the interest rates are very comparable. There have been a couple times where I actually priced out a DSCR loan and the rates are actually a little less. It really depends on what market we're in. Now let's talk about down payment requirements. With the conventional investment loan for a single family, 15% is the minimum down payment required. Same for the DSCR loan. You could put as low as 15% down. When it comes to the multi-families, 2 to 4 unit, with the conventional, you typically have to place 25% down. With the DSCR, you could place 20% down. So you could actually place a lower down payment using a DSCR loan. The majority of investors I work with, they typically want to leverage their cash. They'll put as low as possible down and they will cash out the max possible. So their goal is to have enough cash to purchase more properties and move faster versus buying one at a way higher down payment. Yes, the rate goes a little higher, but the main thing that you're working on, which is invaluable, is time. Time is something that you can't get back. And that helps you to accelerate your business faster. Quick story, I had this one client who purchased properties all cash. He would buy them cash, fix them up with his own money, and just hold on to it. And he moved very slow. He would do 1 to 2 a year as he builds up more cash. Then, when he found out about the DSCR loan and we had a conversation, his whole game changed. He started refi cashing out on all these properties, which he owned outright, moving very slow to accumulate them. And now he's doing these cash out. He's using the cash from these properties and reinvesting in other properties. Now he's moving at a faster pace and able to buy 1 property a month versus 1 a year. Another great feature about the DSCR loan is it allows you to purchase properties that are over 4 units. With the conventional investment loan, you can't. You typically will have to go to the commercial side. The only downside that I see on the DSCR loan, which really doesn't affect me at all, or I really don't think it should affect anyone else, is that there's a prepayment penalty. If you're looking to purchase a property with intentions to keep it, then I don't see why the prepayment penalty will be an issue. Now let's break down what that prepayment penalty is. The standard prepayment penalty on DSCR loans start at 5 years. Majority of lenders will do what's called a step down, a 5-year decline in prepayment penalty. What that basically means is that the first year, if you decide to sell your home or pay off the loan or pay, with some lenders, pay 20% within a 12-month period, you will pay a 5% prepayment penalty on the first year. Second year, you will pay 4%, 3%, 2%, and 1%. So it's a decline in prepayment penalty. There's also the straight prepayment penalty, which is 5% every single year. Very important to talk to your lender about the prepayment penalty so you're aware on which one you're getting. Now you can reduce this prepayment penalty if you like. The only downside to that is that the rate increases. So if you decide to go to a 4-year, your rate typically will be a little higher. 3-year, 2-year, 1-year, typically will be a little higher. Depending on the lender you go with, it might not be as high, but it really depends on your scenario to figure out which lender you're actually going to go with, because everybody's deal is completely different. That's why it's very important to speak to a knowledgeable loan originator who can help guide you on which route to take, depending on what your goals are. Now, if you ran your scenario both through the conventional investment side and the DSCR side, and rates are exactly the same, but the DSCR has the prepayment penalty, I would say go for the conventional side if the DTI works. Max out the 10 and then start using the DSCR loan if possible. If the rate is much lower on the DSCR side, I would personally go with the DSCR side if my goal was to hold the property for a longer term. Because if you think about it, rates would have to go down a significant amount for you to want to refinance, or equity would have to tremendously go up. Depends on what happens. Chances are you're probably not going to refinance the next year because the fees that you pay for refinancing might not make sense to refinance unless rates drop drastically, like maybe 3%. And yeah, definitely do that refinance. Even then, the prepayment penalty that you pay will be rolled into the closing costs and it won't really affect you as much as long as the equity is there. It will help you with your cash flow. However, if rates drop by a half of a point, I personally don't think it makes sense to refinance the next year because of the fees it costs to refinance. Totally up to you on the way you view it. That's just my opinion. Feel free to do what you want to do. I work with investors on different levels and I've seen certain patterns and I've learned myself as well. So make sure that you go through both scenarios to see which one makes more sense for you. If you're interested in applying for the DSCR loan or going over a scenario, feel free to click on the link in the description below, fill out that landing page information. It'll go to me and somebody will contact you to go over your scenario. If you have any questions on what we went over about the DSCR loan versus the traditional conventional loan, feel free to comment. I'll be happy to make more videos on your questions, and make sure you follow because I'll be making a lot more content about DSCR loans and other investment type of loans.